Hi, I'm Brett Hickey, founder and CEO of Starmount Capital. A pleasure to be with you today for part of Star Mountain's Market Insights Views from the Peak. Today we're excited to be here with Dennis Duerst, retired president of 3M Investment Corporation. Dennis, thank you for being with us today.
Yeah, thank you. Happy to be here.
Today we want to drill down on aspects of how to build resilient portfolios, how to deal with market challenges in a proactive manner. None of us can time the markets, but we can build resilient and more thoughtful portfolios. You've had the fortune of working through a number of market downturns and challenges that we want to really extract information from today. So to add a little perspective, tell the audience a little bit about your background and your experience in working through downturns and cycles in general, and then we'll unravel and
Sure.
dig down.
Sure. So as the CIO at 3M Investment Management Corporation, I manage the U.S. pension assets as well as the defined contribution assets. And I was in that role for about 17 years, retired in 2021. So saw the great financial crisis, managed through the COVID period, and certainly there were other bumps in the road during that time.
That's great. And you guys had in total assets, that plan was about how much, Dennis?
Well, we had about $15 billion or so in the U.S. We also manage pools of capital in pension plans in a number of other countries for 3M affiliates. So Canada, UK, Germany, Switzerland. So we invested from a number of different base currency perspectives.
It's great. So lots of complexity for you to have to deal with.
Yeah.
And good insights that you were able to glean from the business operations that were global and international from 3M. So great to get some of the perspectives that you've been able to learn. So when you think about heading into a potential market downturn, as we know, we can't time the markets generally speaking, or at least we don't think we can. But how do you think about building resilience, and how do you think about what's happened over the last 20 years as the number of publicly traded companies in the U.S. has been cut in half and the amount of concentration people have? What are some core pillars of a defensive portfolio that you think of and how you manage portfolios?
Yeah. So we used a broad category of absolute return strategies, which involved private investments, traditional private equity, private credit, but also hedge funds. And so, our focus was really asset liability management. And so we weren't necessarily trying to create the highest returning portfolio, but build some resiliency into what we had.
That's great. And I think even for individuals, when I think about that, I always ask people, what's the purpose of this investment? Is it giving me capital protection? Is it giving me income? Is it giving me total return? Because we're all, to some capacity in life, managing assets and liabilities. So let's talk about some of the diversifying strategies that you have utilized. Which ones have worked well? Which ones have worked less well? And perhaps why?
Yeah. So the focus, I think, as investors approach this topic is how do you find asset classes or strategies that have a low correlation to public markets, and particularly public equity. And I think there's been times that have been very challenging where everything kind of moves together and there's no real ability to get much low correlation or diversification out of your portfolio. So hedge funds to some extent investors try to use, but I think the experience has been that many of those strategies have high beta to the equity markets as well. So as private markets have evolved, and particularly on the credit side, that's become a more interesting place for investors to find that diversification.
That's helpful. So ultimately, as we think about exposure in the public equity markets, what are some other assets that are less likely to move in tandem?
Right.
What about, we've heard investors talk about international. You had to manage a bunch of different portfolios, so you, of course, had considerations. How do you think today about, and what's your experience with different emerging markets? Has that been something that has been constructive or less constructive? I know The Economist came out this week with a great piece around the continued resilience and strength of the U.S. economy in general. What's your experience been?
Yeah, I would agree. The U.S. economy has been amazingly resilient, and investments in international and in emerging market equity in particular have been pretty disappointing. So, the natural response is to say, I'm done with international. I want to focus on the U.S. More in my portfolio.
Well, let's now double click on, as you get into private markets and looking at some asset classes that are less correlated, and how much do you look at the bottoms up approach in hedge funds? There's, of course, lots of forms and strategies and structures of hedge funds, but some of them are trying to have structures that will work within still public market assets. As you think about private markets, are there parts of the U.S. economy in general that you think and you found that can be more resilient and less correlated to larger public companies that are more globalized, perhaps?
Right. So you're really trying to access the real economy, and through private equity and private credit to some extent, you're really getting down into those smaller businesses, those private businesses, the hundreds of thousands of businesses that form the real economy in the U.S. And that's appealing, especially when you contrast it against the S&P 500 with the concentration in the Mag 7. It's a good way to diversify away from that.
That's great. Maybe one last thing, Dennis, as you think about working with a lot of managers over time, and as you think about investing your own personal capital, what are some core attributes you focus on when you're making decisions with your own capital and looking at leveraging all the experience you have and now putting your retirement and livelihood capital on the line as you manage now the assets and liabilities of your life? What are some key characteristics you focus on?
Yeah, well, you mentioned before market timing. It's really hard to market time, so I've always been of the view that you want to kind of average into and out of positions in your portfolio, not take big swings. And then how can you build, those different return streams that have little relation to one another, either through manager diversification or across asset classes.
That's great. And do you look at, I know in our secondaries business where we're evaluating managers, we tend to focus on folks that have worked through downturns, know what it's like, have economic alignment. I tend to think in life that everybody's good at winning, but the true test of character and capability is often dealing with challenges. And I guess inherent in the word challenges is it's not easy. Yeah. How do you think about looking at that, particularly given that we've had such a long positive expansionary period in the U.S. economy?
Right. Well, you never like surprises, right? So you need to develop that relationship with the manager. So if there's something unexpected that develops, you can kind of guess, who is that going to impact the most? And if you have that relationship and that alignment, either they're calling you right away or you're calling them right away to see what's up. And through the COVID crisis in particular, there were certain managers that I knew would have their fingers on the pulse of what was really happening in the underlying economy. And, we tried to stay very close to those managers. And, it was interesting. You had access because nobody was traveling, and you had access to the top of the house, and you could really understand what was going on and how firms were trying to deal with the situation.
That's great. Dennis, thank you for the time and insights, and hope everybody builds good, resilient, diversified portfolios with some real economy in it.
Right. Thank you.
Thanks, Dennis.